So this is almost exactly the same problem, but we have a different business model. The business model this time is to collect contractual cash flows and sell the investment after a considerable time. So collect CF and sell after considerable time. Because of those keywords, our intention, our business model is hold, to collect, and sell. As such, based on the table from our first video, our treatment for this one would be FVOCI. And since this is FVOCI, the transaction cost will now be capitalized. So debit financial asset at fair value OCI and credit cash. 3,700,000 is our initial cost, but we also capitalized the 61,000 transaction cost. On July 1, 2022, once again, we receive our interest, and that would be 4 million times 12% to account for the interest received. So debit cash and then credit interest income. 4 million times 12%, but since this is semi-annual, times 6 months out of 12. However, there's a catch here. Since we are now classifying our investment at FVOCI, we are accounting for the interest income based on effective interest rate method. So we need to prepare an amortization table to guide us. You know, even if it's not required in the problem, I encourage you whenever you encounter this kind of investments, especially if it's FVOCI or amortized cost, you must prepare. So you won't be confused. You must prepare an amortization table. So our initial balance is 3,761. Okay. And let's see here. Based on the data that we have here, our market rate is higher than our stated rate. And we have a mnemonic here. Put in your notes the statement called MAD cup. What do we mean by that? For MAD, if the market rate is greater than the coupon rate, there is a discount. Right? Market is bigger, discount. MAD. For cup, if the coupon rate is greater than the market rate, there is a premium. And there are different terms that you may encounter in your exam or quizzes. For market rate, that is called effective rate or yield rate. For coupon rate, we can call it as nominal rate, stated rate. Those are the other terms. Actually, coupon rate sometimes is given right after the investment or bond that is worded. So for example, the coupon rate here is bonds pay interest of 12% semi-annually. So the 12% there is the coupon rate because that's the actual interest that you are paying. That's the cash flow interest. So you can also say actual interest payment percentage. There you go. Okay. And so we have a 14% effective yield of 14%. So that's your market rate. And it's greater than your 12% coupon rate. Therefore, we have a discount. And we have a discount by also observing the face value of our investment is 4 million. But we have acquired it at a cost of 3,761. Since our acquisition cost is less than the face value, there's indeed a discount. So 3,761, and we will amortize our discount over the years. This bond is also called a term bond. And when we say term bond, this is a bond whose principal will be paid one time, which is on maturity date. Hence, it's called term bond. You pay the bond's principal at the end of the term of the bond, just one time. And if you have a term bond, your goal is to update your balance such that on maturity date, our maturity value would be equal to the face value. We'll have an example later that when we arrive at our amortized cost treatment. But for now, let's complete our amortization table up to the point of the date of sale because we have sold it on July 1, 2023. And so, our interest received will always have a formula of face value multiplied by coupon rate. While for interest income, it would always be the previous balance multiplied by the market rate. And for the discount amortization, the discount is signifying that our balance is lower, our cost is lower than the face value. Over the years, when you amortize, another term for amortization is basically eliminate. When we eliminate over the years the discount, our balance will go up. Take note of that. Discount amortization increases our balance. So interest received would always be 4 million face amount multiplied by 12% stated rate. I'm getting the amounts there on the side. And then since this is semi-annual, you multiply it by 6 months out of 12. So to put it simply, 4 million multiplied by 6%, right? Because this is semi-annual. For interest income, it will be based on the market rate. The market rate is 14%, but since this is semi-annual, this would be previous balance multiplied by 7%. Alrighty. So now let's focus on the amortization table here. Our balance initially is 3761. That's the previous line balance. We multiply it by 7%. And the discount amortization is the difference between our interest income and interest received. So once again, the effect of balance in our balance for the discount amortization is it will increase. It will have our balance to go up. So now our balance is 3784,270. Let us continue. Since this is a term bond, your face value will not change. It will be 4 million until the date of maturity. You will always have the same interest received. For interest income, however, you need to update it because now you have a different balance, right? Previous balance multiplied by 7%. Get the difference. Discount increases our balance. For the last line, previous balance multiplied by 7%. Get the difference, and the difference increases our balance once again. So that is the amortization table up to the date of sale. Now, if we go here, on 7/1/2022, what happened? We received the interest. We already accounted for this column, but we have not yet accounted for the discount amortization. So there would be a debit for since this is a discount amortization, it increases our financial asset and we recognize interest income. And that is based on the green amount there, 2327. All right. And that would be our Just don't mind that 378,470 over there. Our entries just debit and the interest income. There you go. Okay. And so, what would be our carrying amount on 7/1/22? All of these questions can be answered through the amortization table. So, let's zoom out a little bit. Our carrying amount on July 1, 2022 is 3,784,270. Our carrying amount on 12/31/2022 is 3,809,168.9. Our unrealized gain or loss, okay, we don't know that yet. But our interest income in 2022 would be our interest income in July and our interest income in December 31, 2022. So from January to July, and then to June, and then July to December. So let's write that down. This is based on amortization table. This is also based on amortization table. And this is our January to June interest income plus July to December interest income. Alrighty. So at the end of 2022, just like in our previous problem, right? Our bonds are quoted at 105. Since this is FVOCI, ultimately, the value of our investment is based on fair value. So, our fair value would be 4 million. The quoted price at year end is 105. So, 4 million multiplied by 105% is 4,200,000. Okay. Regarding the carrying amount at year end, we should compare and update first the carrying amount in July. That is 3,784,270. Remember that there is a discount amortization on 12/31/2022, which is 24,898.9. That's from the amortization table, right? So this is our carrying amount on December 31, 2022 before fair value adjustment. Right? It's basically the number from the table there. 3,809,168.9. So that's our carrying amount before the adjustment. Our fair value is 4.2 million. So we have a gain. A gain of 390,831.1. And since this is FVOCI, this unrealized gain will be classified as OCI. Let's put a note here. Put note, update, before we compute for the unrealized gain, update carrying amount first based on amortization table before computing for unrealized gain or loss. Okay. We have transactions next year because we have sold our investment on July 1, 2023. Before we account for that, let's first recognize the interest received and the discount amortization up to July 1, 2023. That's our instruction from our table, right? And so, and even before that, our journal entry at year end would be for cash received, that would be debit cash, credit, interest income, 240,000. Once again, that is the face value 4 million multiplied by 12% multiplied by 6 months out of 12 because this is semi-annual. Then on December 31, 2022, we have amortized this financial asset and then credit interest income. And that is based on the amortization table, right? December 31, 2022 line, the blue cell, the discount amortization is 24,898.9. And lastly, after updating the carrying amount based on the amortization table, now we recognize our unrealized gain. So we debit financial asset, FVOCI, and unrealized gain, OCI. So there would be 390,831.1. But take note that if your problem requires you to just compute for December 31, 2022, we would now have a different answer, right? It's not the amortization table anymore. Since this is based on fair value, your carrying amount on December 31, 2022 would simply be the fair value at year end, since this is fair value OCI. So 4.2 million. Our unrealized gain, once again, is our fair value minus the carrying amount based on the amortization table. So our unrealized gain would be 390,831.1. Okay. And just to repeat, our interest income is based on the amortization table from January to June 2022, from July to December 2022. Now, let's proceed. On the date of sale, once again, we first recognize the interest received, and then we recognize the amortization discount. Then we can talk about whether we have a gain or loss on sale. Let's see here. For the 7/1/2023, once again, we have received the semi-annual interest, which is always the same. Face value multiplied by 12% times 6 out of 12, that's 240. And then we also recognize the amortization of discount. Once again, when we amortize, when we eliminate the discount, we increase the value of our investment and credit a corresponding interest income. So this would be 26,641.82 based on the amortization table. That's the good thing about the amortization table. If you haven't prepared this, you will now think again, okay, how would you compute it again? I would update this in 2022. Now I would update this in 2021 or in 2023. At least when you prepare the amortization table one time, every problem can be answered in the amortization table, right? You can use that as a reference. So that is the amortization again on July 1, 2023. The difference between the interest income and the interest received. So 26,641.82. Okay. So that is step 1, right? And we are now following, remember in the previous video, there is a long list here regarding step 1, step 2, and step 3. When we sell, this is now the application of that. So make sure that you are matching the theory part as well as this problem treatment. So recognize interest received and discount amortization until July 1, 2023. Now that we know that, we proceed to the next step. Step 2 would be to update our carrying amount to match the fair value. Remember, the fair value is equal to the selling price for the year. So that would be a debit. Let's see if it's indeed a debit or a credit. Let's go to the side here. Okay. So our fair value would be the selling price on the date of sale, that is 4 million multiplied by 1.1. Again, just a recap, here it is, right? 110. Okay. And for our carrying amount on 7/1/2023, that would be based on our first the carrying amount from last year, that would be the fair value, and the discount amortization in 7/1/2023, which is 26,641.82. Right? So just to reiterate, this would be our carrying amount, the carrying amount in 12/31/2022, which is the fair value in 2022, plus the discount amortization in 2023. Right. So this would be our unrealized gain, OCI. We have updated our unrealized gain or our carrying amount to match the selling price. So we will increase our financial asset at FVOCI and have a corresponding credit unrealized gain, OCI. That would be 173,358.18. Now, the updated value of our financial asset is indeed 4.4 million, right? So, because we have recognized the discount amortization, at the same time, we have recognized the unrealized gain. So, since our financial asset is already, the value of that is already at selling price, there would be no separate gain or loss on sale, right? So, step 3 would just be to recognize the sale. So, put a note here. Say that there is no gain on sale, only gain on investment. So debit cash and then credit financial asset at FVOCI. 4.4 million, 4.4 million. So now our financial asset FVOCI is completely eliminated. In our previous notes, remember that we would recognize also the accumulated unrealized gain, right? So where is that accumulated unrealized gain? That is the unrealized gain that we have recognized initially in 2022 and the unrealized gain that we have recognized in 2023. In 2022, we have recognized 390,831.1. And in 2022, we just recognized it from the previous entry, 173,358.80. So we have an accumulated balance of unrealized gain OCI, 564,189.28. Since we have met the classification of FVOCI, this is an FVOCI mandatory. Therefore, the entire balance of unrealized gain OCI would be classified to gain on investment. This would increase our profit or loss. All right. So this would be 564. And just to show you the difference that ties up with our theory notes a while ago in the previous video, what if the FVOCI is not made in our through mandatory classification, but it's originally FVPL, but we classified it. We made the irrevocable election on initial recognition that this would be classified as FVOCI. Everything, what you're seeing above, everything is the same, except for recognizing the sale in step 3. So when we recognize the sale, in fact, this is the same, debit, cash, credit, financial asset. Again, step 1 and step 2 Whether your FVOCI is mandatory or you made the irrevocable election, you have the same treatment. But for step 3, when you recognize the sale, in terms of derecognizing the accumulated unrealized gain, which is still 564, instead of entering it as a gain on investment and increasing your net income for the year, if your FVOCI is via irrevocable election, you would straight up transfer it to retained earnings instead. So this won't have any effect. There is no gain or loss if your if you sold an FVOCI via irrevocable election.